Hello, I'm Isla de Haldevang, Client Administration Manager here in Haddington, and I'm joined today by Guido Bicocchi, our Director of Investment.
Hi.
To discuss our approach to stock selection in the latest of our investment thinking videos. However, before we begin, I'd like to remind you that the content of this video is McInroy Wood's opinion. It is not intended as a recommendation, promotion or advice.
Thank you, Isla. Many of our investors and clients are interested in the stocks that we hold in their portfolios and how they perform in different economic conditions. But we believe the investments that we choose to exclude from the portfolios are just as important to the performance.
So Guido, simply put, how do you decide what should or shouldn't be in a portfolio?
The primary objective for all of our investment portfolios is to preserve the value of our clients' and investors' capital and income after inflation. All of the portfolios are managed with a long-term investment horizon, and we undertake an independent assessment of the opportunities and risks rather than slavishly following stock market trends or the constituents of an index. We look to invest in companies with a specialist niche or that provide critical components or services. The industries that we favour are less exposed to cyclical demand, but offer opportunities for strong long-term growth. And simply put, if companies don't meet that criteria, then we won't invest in them.
Can you give me an example?
Yes, so our diligent approach meant that we didn't invest in technology companies during the technology crash of 2000. We avoided banks during the financial markets crash of 2008. And our focus on defensive quality businesses also helped to protect the value of portfolios in the early days of COVID in 2020, as well as the geopolitical uncertainty that accompanied Russia's invasion of Ukraine. And by protecting portfolios from the worst of stock market falls, we believe they're then better positioned to benefit from when times are better. And over the long term, that provides the best opportunity for us to achieve our clients' and investors' needs.
Now, you know I'm going to ask this question, but have there been times where you wish you had invested in a company?
Of course, we can't invest in every successful business. For example, we've never invested in any of the American internet stocks like Google or Facebook. And over the years, they've grown to become some of the most valuable companies in the world. But those companies don't share many of the characteristics that we look for in our investments. Their fortunes may be determined by things like stock market fashion or by advertising, and the valuations of those companies are just not justified by the company fundamentals. Instead, when we're interested in a particular investment theme, like the internet or digital communication, we look to invest in companies that are going to benefit from the growth across the industry, such as companies that are providing critical components in the manufacturing process for semiconductors.
And has this approach worked?
Yes, and I think that's evidenced in the long-term performance of our funds. So since its inception in 1990 until the end of March this year, the McInroy Wood Balanced Fund provided an annualised return of 7.9%, which compares to UK RPI inflation of 3.4% over the same period. Now, I'm sure viewers will treat those historic numbers with the scepticism that they deserve as a guide towards the future, but hopefully it provides evidence that our investment approach has achieved the objective that we set out to, which is to preserve our clients' and investors' portfolios against inflation.
Guido, we're often asked by clients and investors alike, what about the merits of investing in alternative asset classes, such as property or private companies?
In our experience, in most cases, a sensibly diversified portfolio of different types of assets is the best means of achieving our investors' and clients' objectives. Investments in assets such as property and private companies do provide attractive returns over the long term and can protect against inflation. Indeed, in recent years, other investment managers have increased their allocation to these types of investments. However, typically these assets are not very liquid, so they're difficult to sell quickly, particularly in times of market stress, which is when we may want to sell them in order to switch into a different asset class, such as listed equities, which at that time we feel provide a better long-term opportunity for growth. Furthermore, we're managing portfolios on behalf of individuals, families, trusts and charities. And while they all share the same long-term investment horizon, they may need to withdraw some or all of their portfolio at short notice in order to provide for emergency repairs to the house, or buy a new car, or help family members actually buy a house. So we have to make sure that we hold liquid investments so we can meet those needs.
There's been a lot of consolidation in the investment management industry in recent years. We're one of the few remaining independents. What would you say to investors and clients who are perhaps nervous of this trend?
Genuine independence has always been one of our core principles. So the firm is owned by the directors and the employees, which means we're free from any external influences by other shareholders. And that allows us as a board to take long-term investment decisions. So whether that's in terms of facilities or technology or people, free from the pressures of having to meet short-term profit or dividend targets. We've always relied on our professional reputation and referrals rather than short-term performance to attract new clients and investors. And we're committed to continuing with that strategy, avoiding the risks associated with mergers and acquisitions that some of our peers have pursued. Independence is also critical to our investment approach. We undertake our own assessment of the prospects and the risks of any investment. And I think the evidence of the success of that approach can be seen in our long-term performance record.
Thank you for joining us today. I hope you found the session useful. As ever, if you have any questions arising from our discussion today, or about your investments, or any suggestions about what you'd like us to talk about in future, please do get in touch.